You could do everything right for retirement, build a $2 to $3 million nest egg, invest wisely, live modestly, and still get blindsided by the IRS. In today's video, I'll break down how RMDs or required minimum distributions work, why they get more punishing as you age, and 4 powerful strategies to reduce or even eliminate their impact. This is one of the most misunderstood retirement traps out there, and knowing how to navigate it could save you and your family a fortune. So let's get into it. Time and time again, we meet people approaching retirement with one big question: will I run out of money? And it's a good question. They build what they think is a solid retirement plan, see that they can safely withdraw 4 to 5% per year, and breathe a sigh of relief. Looks like they're set, maybe even comfortable. But here's the truth. The IRS doesn't care about your retirement plan or your conservative withdrawals. And you might be facing a much bigger problem: getting taxed on income you never even needed. Picture this: you're 90 years old and the government forces you to pull hundreds of thousands of dollars out of your retirement account in 1 year. Even if you don't need the money, you still have to pay taxes on it. And that single event could spike your Medicare premiums, put you into higher tax brackets, increase the taxes on your Social Security, and ultimately shrink what you leave to your family. If you thought retirement just automatically meant lower taxes, think again. I'm Brandon Clark. I'm a certified financial planner and a certified private wealth advisor, and my mission is simple. It's to help you maximize your retirement and keep more of what you've worked a lifetime to build. As always, the opinions expressed in this video are for educational purposes only and should not be taken as financial advice. So, what is a required minimum distribution, or RMD for short? Well, an RMD is a minimum amount that the IRS forces you to withdraw each year from your tax-deferred retirement account. So think your traditional IRA, 401k, 403b, or other similar plans. Why does the IRS care? Why do they do this? Because you haven't paid taxes on that money yet. All of those pre-tax contributions came from you and maybe your employer, or you each got tax benefits. You both received deductions against income in the year of the contribution. In addition, you received years of tax-deferred growth. So what? Well, Uncle Sam has been patiently waiting for his fair share and does not want you to defer taxation forever. And starting at age 73, he wants his cut. That age has changed over the years, so the RMDs used to begin at 70 and a half, then shifted to age 72, and under current law, it's now 73. But here's what's coming next. By 2035, the starting age will increase to age 75. The amount you're required to take out, or the calculation, is based on your account balance at the end of the previous year and a life expectancy factor set by the IRS. This is what's called the Uniform Lifetime Table. The formula is pretty simple. You take your account balance at the end of the year, so December 31st, and you divide it by the life expectancy number at your age to get your dollar amount for the RMD. If you have assets with a major custodian, let's say Charles Schwab or Fidelity, they usually help calculate your RMD amount for you. At age 73, the withdrawal is around 3.7% of your IRA. That might sound manageable, but fast forward to age 90 and your RMD jumps to 8.2%. At age 95, over 11%. Now, if you're somebody that doesn't need that kind of money from your retirement-specific account to live comfortably, this can create a tax nightmare. And here's the catch: you must withdraw it, even if you don't need that additional income. And every dollar is taxed, the worst kind of tax, ordinary income. Now let's put things in perspective with numbers. Say you retire at age 65 with $2 million in your traditional IRA, and your investments grow at a hypothetical 8% per year. You don't have to take RMDs until age 73, but your account continues to compound during those years, and withdrawals are factored in. So by the time you're 90 in this hypothetical example, your IRA is worth approximately $5.7 million, contingent of course upon portfolio performance and earlier withdrawals. Now apply the IRS RMD calculation, which as a percentage for age 90 is 8.2%, and you're looking at a forced withdrawal of over $460,000 in just that year. That's $460,000 roughly in taxable income. That's not nothing, and in our opinion, it does seem likely that taxes will rise over time. Now, maybe not within the next few years under the current administration, but over the next 10, 15, or 20 years, it does seem likely that taxes will rise. That additional income through your RMD can push you into a higher tax bracket, cause up to 85% of your Social Security to be taxed instead of, let's say, 50% or zero. And this is a big one, it can trigger IRMAA, which applies to Medicare Parts B and D. Essentially, the higher your income in retirement, the higher your Medicare premiums. So if your income fueled by those big RMDs exceeds certain thresholds, you could be paying hundreds of dollars more per month in Medicare premiums. And the thresholds are pretty steep. So for example, in 2025, if your income exceeds $212,000 for a married couple or $106,000 for an individual, you'll start seeing those surcharges. And that's not just a one-time hit. It can happen every year, especially as your RMDs increase over time. That's almost like an additional tax every year. Now, RMDs don't just stop with you. Under the Secure Act, most non-spouse beneficiaries, so think your adult children if you have any, they must withdraw the entire inherited IRA within 10 years. That means big tax hits for them, likely during their peak earning years. Not only do they have to deplete the account in 10 years, they also have to take out RMDs each year if you were taking RMDs as well. So according to a study by Penn, the average age that you receive an inheritance is age 51. And that's likely when your child is in their peak earning years if they have a successful career, meaning a higher likelihood that your IRA will be taxed at higher rates. In other words, the government gets a much bigger piece of your legacy unless you plan ahead. All right, now let's talk about those 4 ways to reduce or even eliminate RMDs. It's not all doom and gloom. So the first option is through Roth conversions. By converting portions of your traditional IRA to a Roth IRA, you will pay the taxes now, but that money now grows tax-free, and Roth IRAs have no RMDs during your lifetime. It's one of the most effective long-term tools to reduce future tax exposure. Essentially, you bite the bullet now to save yourself from taxes later on. That said, keep this in mind because it is often overlooked. Roth conversions will increase your taxable income in the year you convert, and that could also bump you into a higher tax bracket and temporarily increase your Medicare premiums due to IRMAA if you're in retirement. But here's the trade-off. By paying taxes at today's known rates, you reduce future RMDs, potentially lower IRMAA premiums later on in retirement, and you leave your heirs a tax-free legacy. And under current law, Roth IRAs passed to your children still have to be emptied within 10 years, but they won't owe a dime in income tax on those withdrawals. Oftentimes we come across people that are doing Roth conversions or they want to do a Roth conversion without really understanding exactly how much they should convert and the timeline specifically for when they should be doing the conversions. Just like we always recommend, a well-crafted financial plan can help uncover what makes the most sense for your situation. So the second way to eliminate taxation on RMDs is through qualified charitable distributions or QCDs. If you're age 70 and a half or older, you can donate directly from your IRA to a qualified charity using a qualified charitable distribution. In 2025, that limit has increased from $100,000 in years past to $108,000 per year, and that amount can count entirely towards your RMD. Even better, it's excluded entirely from your taxable income, which means no IRMAA impact, no extra tax on Social Security, and no increase in your income tax bracket. If you're already charitably inclined, a QCD is one of the cleanest and most tax-efficient ways to give. However, I only suggest this to clients if they're already charitably inclined. If you're not, donating just to avoid taxes is usually not the best move. Now, the third way to potentially reduce RMDs is through strategic asset location. Having a strategic asset location with your allocation is one way to maximize each type of investment account that you have. We often come across potential clients that have the same allocation, let's say between stocks and bonds across all different types of investment accounts. So Roth IRA, traditional IRA, or taxable brokerage account. However, I heavily disagree with this approach. And instead of just having a 70-30, let's say stock bond allocation across all accounts, you typically want to place your hyper-growth investments in Roth IRAs, so little to no bonds, where they can grow and aggressively compound 100% tax-free. Then potentially keep more moderate growth or even income-focused assets in your traditional IRA, and taxable brokerage accounts can have more preservation of capital with income factored in. By doing this, you'll reduce the long-term growth in your IRA, which might sound counterintuitive, but that means smaller RMDs and potentially lower taxes over time while letting the tax-free bucket grow nicely. Of course, everyone's situation is different, so understanding risk profile and long-term goals very much plays into this approach. Lastly, the fourth option is to use the joint life table. If your spouse is more than 10 years younger and your sole beneficiary, you can use the joint life table, which lowers your RMD percentage. The thought process with a lower RMD for a substantially younger spouse is that the IRS wants to limit withdrawals to help ensure the longevity of the retirement account for the surviving spouse. That small adjustment can significantly reduce how much you're forced to withdraw and even report as income each year relative to the uniform table that we discussed earlier. RMDs are a perfect example of how tax planning and retirement planning go hand in hand. They're not just a rule to follow. They're a potential threat to your retirement income, your healthcare cost, and potentially your family's future. But the good news is, with the right strategies, the right approach, like Roth conversions, QCDs, optimizing asset location, potentially using the joint life table, you can stay ahead of the IRS and take back control of your retirement. If you would like personalized help building a tax-efficient retirement plan to potentially manage RMDs, click the link in the description of this video to schedule a call with our team. We help people just like you make smarter decisions about retirement. Hopefully I was able to help you maximize your retirement. And don't forget to hit like and subscribe to see more content like this in the future.